Okay, this is a quick video on moving averages and how they might influence our swing trades. I just have the SPY up here, and the two averages that I normally use are the 15 or the 20-day moving average and the 50-day moving average, and the relationship between those two. The key point to remember is that moving averages are a lagging indicator. So stocks will react much quicker than they'll be reflected in the moving averages. But in terms of technical analysis, there are certain key points where signals are given, and of course here is where the 20, in this case the 15, crosses the 50. There's your buy signal, and sure enough, look, this thing kept going. Now it is a lagging indicator because we're technical analysts. We look at other factors as well. We could see here that we had this big capitulation, gapped up V bottom right hand extension. This is where we went long the market here, April 7th. I did a video on the bear at the bottom of the bear has occurred. We need to get long, and so then we traded this. But it wasn't until 1st of May that the 20 or the 15 in this case crossed the 50, and though it did is also a very good signal. Look where it, and then it never did fail. So you could have stayed in this trade if you had, because what you find is when the 50 or in the 15 and 20 crosses to the downside, that's a negative and you want to get out of the stock. Let me just have a quick look at one that might give us that. Here, this is LABU. We can see here where the 20 crossed the 50, or sorry, the 15 crossed the 50 here. There was your sell signal. Now again, it's a lagging indicator. There was lots of opportunities that you should have got out of this stock long before that, or in this ETF, but there's your signal. So it's a lagging indicator. So now how does this influence us on the buy side when we put a swing on? Well, we can see there's a lot of other patterns that are involved that we would be ahead of the lagging indicator where it traded through it, that we would take a trade on long before the 15 or 20 and the 50 come into play. So LABU triple bottomed here, popped out of a declining channel line, and we put the trade on here. Now this would be resistance for it, but it did pop up through it, and lateral resistance, pulled back, held support on the 20. It's still holding support on the 20, as well as the lateral here. But you can see here it got up to the 50 and failed, and that was this was our target at 85. And there's a reason for that. Here, so you have this lateral resistance at 85, but also your 50 is going to be resistance for the stock to get through, and pulled back, but now it's holding support on the lateral and the 20. So that's how we use the 20 and the 50 as ongoing guides for trades that we put on. But the main point that we put a trade on is the chart pattern, and not necessarily influenced by the 20 and the 50. The 20 and the 50 are more, in my opinion, and what I use them for, is the direction. You can see here and here, this is a big, strong move up in the, the direction. It really is a good visual interpretation of where this market is going when we get these big, the trending up like this, especially on the daily, versus, and again, where it came down. Very good indicator of where the market is going. You can see here every time it got to the top of at the 20, it failed. The 20, it failed. 20, it failed. This time it broke through the 20 though. came back and tested it. So that's a bullish sign. Prior to that, same here, it tested all the way up. Tested these. Here it failed it, but broke back up through it. And then tested. So, this is a good indicator. It's a good support line for it. And when it broke it here, you would have sold it here, sold it here for sure, sell it. And then sell. And now this also did coincide with the downtrending channel. So we had two or three good reasons why we wanted to sell that stock at those points. So it does bring in, it does come into play, but it's more, it gives just visual direction or it just reinforces the position that we take at certain inflection points on the swing trades, but it isn't the guiding factor for putting a swing on. For instance, G-Box that we just put on the other day, the 20 had actually just crossed the 50. But this is the chart pattern I like, a V bottom right-hand extension popping. You would never be able to catch this trade if you waited for the 20 to catch the 50, break through. Now you might be more secure in your bet. Not that we're gambling, but you might be more secure in your analysis that this is a better time to take it after the 20 crosses the 50, back up. But you're going to miss a lot of the move, perhaps. So we take this trade because we had this V bottom right-hand extension, and we know that pattern is a powerful pattern, and 70% of the time you're going to get continuation. But this is resistance for it. It does need to get through this level of resistance at the 50, 1180, which also coincides with, lateral resistance. But if it does break through it and starts to go, and then the 20 crosses it, that's going to give us a very good indication of the direction of the stock.